Okay, very good morning, Tuesday 23rd of May. Get the briefing underway and straight to it. We just had the latest of the flash manufacturing and service PMIs. We've had Germany just come out, and with the German numbers, statistically speaking, a minor miss on the service number does in fact mark a 3-month low, but manufacturing 59.4 against expected 58. That's a 73-month high for German manufacturing. So if you thought there were any reasons to doubt the kind of engine room of Europe, particularly with the euro appreciating more recently, then certainly that's been brushed aside. Manufacturing is still continuing apace in Germany, and it's just meant there's been a little bit of further strength in the euro currency upon that release, just bringing us back in sight then of that high print seen from yesterday afternoon. We're just about to test it now as I'm speaking. Well, there you go, straight through. So some further bids in the euro, 112.78.5 there. Upside then, you'd have quite a big level of resistance, technically and psychologically, at the 113 handle. Just 4 pips shy of that level, you've got the R1 on the day at 112.96. But a little bit of euro appreciation here, rather than anything dollar driven, just on the back of some of this data. On the French side of things, we had them earlier, and just given the kind of setup of the economies respectively, France is kind of the other reverse situation. So service sector in France, PMI was 72-month high, but their manufacturing a 2-month low. But overall, fairly robust data in the Eurozone continues, and these PMIs have been tracking with relative strength of late, hence the ECB looking towards the summer for any potential changes. So that's certainly lifted the mood a little bit. The DAX also, after a brief dip this morning, shortly after the futures open, we're back up within sight of the opening high prints that we had yesterday, that kind of matching up with the R1 should we get up to that point this morning. And the S&P has already had a close to a test of the highs that we're seeing really in the early part of the Asia Pacific session, seen up at around the 23.95 type level. So that's the data that's just come out, but certainly there are a few other headlines that I want to go through. And I want to try and wrap this up really in the next 20 minutes or so, because we've got German IFO coming out at 9 o'clock, which will also be a key figure to monitor. But probably the headlines now that you've read on your way into work is we've had another tragic event on a terrorist side, this time on our own shores in Manchester. Last night, a terror attack is now reported to be 22 dead, with around 50 injured at that explosion that took place at the Manchester Arena during a concert last night. That did result in slight risk aversion last night in the early part of Asia Pacific trade, but then it was largely kind of brushed aside. But obviously, from going forward point of view, certainly we've already had this morning a situation develop and investigated by the Met Police at the Victoria coach station in central London. And so I've already seen the City Police, the Met Police, putting out alerts that the streets will be armed with more police than normal. So there will be heightened security. So you could hear further kind of updates as we go through the day in regards to investigations, the suspect packages, things of that nature. Just to kind of get it into perception of what you might be hearing on the squawk later. But not going to dwell on this too much. But from a market point of view, obviously, despite the risk aversion briefly last night, things have kind of moved on, and now we're looking at the DAX retesting highs as I speak, with some euro appreciation on the back of this latest data that's come out. Moving back to oil, we can just see at the bottom of my charts at the moment, we are now trading sub a 51 handle. As kind of really we were talking about yesterday, I'm kind of looking for a little bit of consolidation between, I guess, 50.50 and 51.50, defining the price movement really of the last day or so, since certainly we've come back in, and following this quite sharp appreciation that we've had certainly on the build-up into the OPEC meeting on Thursday. Obviously, the main key here is Saudi Arabia at the weekend talking about all seem to be on board for the 9-month extension. However, yesterday, reports then circulated about the prospect that maybe Iran and Iraq will not join that. Well, this is kind of some of the latest headlines you're seeing this morning. Iraq paves the way for OPEC deal with support now for the 9-month extension to cuts. Iraq being the second largest of the OPEC producing nations, this is absolutely key that they're all part of this deal going through. The backing comes for longer cuts after talks with the Saudi counterpart, because Iraq had previously just favoured a shorter 6-month extension. The reason why I'm talking about Iraq is important is because of this graphic. As I said, Iraq are very instrumental or influential to the facilitation of the deal in terms of the size of the cut that gets put into play. And this is because Iraq missed its output cut target by the most among OPEC peers in the first quarter. So if you were talking about OPEC overall compliance, we were talking about that being around the 100% mark for the first time in such a long period, because they had a very bad track record of actually sticking to predefined targets and quotas. And really what's happened is that OPEC, you could break up into several components, and Saudi Arabia have gone over and above to kind of pick up the slack of some of the other nations. And in particular, Iraq was one of the largest, if not the worst offender. They were 80,000 short of still needing to cut that amount in order to just adhere to target, whereas Saudi Arabia almost went 180,000 above what they needed to. You know, this shows a few things. Some, the difficulty in managing the compliance overall, given the fact that Iraq is having to come back from obviously the Iraq war, their facilities still coming back online. If anything, they want to pump more to make more money in order to deal with their deficit and fiscal situation. And so Saudi are having to pick up the slack. They obviously have the ability to do so because they are such a larger, by proportion, producer of crude oil. But how long can Saudi keep doing that is the question, and how long can they maintain this type of relationship where they're having to backstop these other nations? So something to just keep an eye on. One of the other headlines I've just seen this morning as well, Kuwait, who's up there as one of the other top line producers, they've said that their countries will discuss in Vienna whether 6 or 9 month output cut extension. So maybe still not a complete done deal by the sounds of some of these comments this morning. And certainly the way that the market's priced up around this 51 type level in crude, if a 9-month deal cannot be done, then certainly there's plenty scope for downside retracement of some of this priced in fact that we've had of a 15% rise since the beginning of May. Okay, some of the other headlines. So you're aware, Trump today will be unveiling his budget, calling on Congress to push through $3.6 trillion of spending cuts. The budget targets anti-poverty programs and military and social security. So looking at a couple of charts here that are quite interesting with the Trump budget is that obviously the big question is about, can you spend your way out of a crisis? Can you cultivate economic growth through spending, which obviously is what the whole fiscal program that Trump has been kind of delivering or trying or attempting to at least, and the market, hence we've moved so high in equity space. But when you actually look at the underlying assumptions that the Trump administration is saying comparative to what Wall Street economists are predicting, there is quite a severe divergence. So Trump projects a balanced budget by 2027. Obviously, if you're spending more, the government's going to get more in debt. But what Trump is hoping is that as economic growth and productivity picks up, therefore that pays down the debt. Whereas more fiscal-leaning hawks on the GOP, for example, want to reduce spending and heighten taxes in order to kind of go for the more austerity type approach. But Trump looking to spend his way out of trouble, so to speak. And what we're looking at here is what their projections are. This is what Wall Street are looking at. so projected deficit as percentage of GDP, whereas Trump administration is looking at projected budget surplus by the time we get down to kind of 2027, 2026 type period. So in terms of GDP in the US, Trump is looking at accelerating to 3% by 2021, which is here, whereas the Congressional Budget Office is looking at less than 2% GDP over the period of 21 to 27. So quite a big disparity here, and I think though that what we've come very accustomed to is what Trump is trying to force through, and what he says, what actually will end up materializing could well be two distinctly different things. So quite a large difference at the moment, and I'd say that gap needs to be closed, and some compromises or movement on these terms or numbers might need to be discussed on Capitol Hill. Trump's budget relies on high GDP. We've just said that to projected change in year-on-year growth on GDP. Trump administration compared to the Congressional Budget Office projection, there's a huge discrepancy there. 1% of GDP difference is a phenomenal gap. And in terms of what you're saying then, the extra revenue that would bring in if Trump were correct. But obviously this is a big hypothetical case when GDP is much lower than this at current levels. Some of you are probably already familiar with the kind of where the money is being targeted by the Trump administration. And what's surprising here is that these are all the governmental departments, if you like, and his plans are to take an absolute sledgehammer to 90% of the departments at the expense of parking all that cash into increased defense and homeland security spending. Obviously this is very much the angle which he was following during the campaign trial, being more aggressive on the international scene in foreign affairs and so forth. But you can see here, Environmental Protection Agency absolutely slashed here by 31.4% is being proposed. Department of State, Agriculture, Labour, Health and Human Services, Commerce, Education, you name it, it's all coming out of that and all going into defence, essentially. And so, whether or not the other chambers of Congress can see eye to eye on this type of quite one-dimensional type spending is yet to be seen. So do we get stuck in a situation again between Trump wanting to deliver something and then actually the implementation of that being met with resistance by other politicians within his own Republican Party? Okay, quickly, a quick look at other news. You've got Brexit updates. Obviously, this time yesterday we were talking about the EU saying they want 100 billion in divorce settlement bill before trade talks can begin. David Davis saying we'd walk away if there's no sensible conversations happening. Even 1 billion is a lot of money. Well, essentially Germany warned that reality of Brexit had yet to break through in London on Tuesday, as the EU unanimously agreed an uncompromising negotiating mandate for their exit talks. This is kind of all part and parcel, I guess. The EU not willing to budge at this particular point in time. The actual real formal talks don't start beginning until the week commencing June 19th. So up until that point, I do not foresee any kind of give on either side until they actually come together at the table. At the moment, these are kind of shots being fired, if you like, at other viewpoints in order to get the negotiating posts out there. Another headline from overnight, and this certainly hasn't gone away, and this is a story which certainly will come back into more sharper focus in the summer months, and this is Greece, because Greek creditors have failed to reach a deal in 7 hours of talks. This comes at a real critical point for Greece because they've got a huge amount of debt redemptions looming in the summer month of July, and so Greece's creditors have failed to reach a deal on debt relief for the country, leaving the euro area locked in a race against time to finish negotiations before Athens faces crippling repayment deadlines in July. This is a graph you may remember from before, which is basically Greece's debts and when they're due. What you can do here, this is on the Wall Street Journal, you can define Greece's debt by each individual year. And what it does then, it shows when that debt needs to be repaid and then to who it needs to be repaid to. Remember, Greece's bailout is funded by multiple parties, the IMF, the ECB, the European Investment Bank, private investors and so on. And you can see very much through the beginning of 2017, Greece really doesn't have any repayments to be made. But come June, there's a couple here where US Treasury bill holders are due to be paid, and then July is when it really heats up and there's double-digit amount of billions of euros that will need to be paid back to various holders. And so hence the reason why at this point Greece cannot afford to pay back. If they do not get a bailout from Europe and the various other Troika members, they will default. Now, let's not forget, this isn't particularly untrodden ground for a country like Greece. It has happened before, but Europe will be doing its utmost to try and formulate some type of agreement. So probably headline coverage on this issue will intensify when we get probably into the month of June, so they get a deal struck before these payments become due. Okay, quickly then, look at the calendar. Again, I want to wrap through this because we've got IFO in 10 minutes time. We've already had the flash service PMI numbers. These are important, hence the reason why they've already had an underlying impact on the markets this morning. I can see though that the DAX thus far has been contained by the previous day's high in R1, hasn't really managed to push above that. Likewise, Euro on yesterday's high as well. One of the interesting thing actually with the currencies at the moment, and just talking to one of the guys here this morning, was that I'm just looking at cable here, the bearish fundamentals seem to be stacking up for the pound. You've had this latest terror attack happen. You've obviously got the convergence in the polls making the election slightly more uncertain than maybe it was a few weeks ago. You've got heightening inflation, putting more pressure on household incomes. So there's a number of negatives that seem to be developing, and yet the pound's still sitting on 130. And what I think is happening here is that a lot of this is still being derived from movement in the dollar, which is helping negate some of the negativity that's building for the pound on a fundamental basis. Because at the moment, as has been the case for the last few months, Trump continues to be the main driver at this present point in time. And with the dollar still remaining relatively weak, we will be continuing to monitor developments as he continues his kind of international tour throughout the week. I believe today he's in the Vatican. He's got the budget announcement details coming out as well. And then later on the week he's at the NATO summit on Thursday and the G7 summit at the end of the week. So a couple of interesting things to keep an eye out for. I think the dollar movement still needs to be factored in, certainly with cable, because the price in the pair still holding up amid that dollar weakness, despite the negatives for the sterling currency. Back to the calendar though, German IFO coming up. Let's have a quick look at how that's been of recent trend. And the last 12 months, there's been really quite an incremental incline in this data set. And the last month at 112.9 was the highest reading in German IFO since July of 2011, this number. The expectation value today on the headline reading is 113.1. So we're looking for still very strong optimism. Remember, this is a soft piece of economic data. This is IFO is one of the most important numbers out of Germany because it's looking at actual companies' forward-looking expectations of the economic environment over the next 6 months. And so as long as they remain optimistic, then you would say investment continues in the economy and so forth. And so that things like the PMI, which is hard data, then should follow suit. And you've got good solid performance in both soft and hard data, hence the euro being up at these quite elevated levels. If anything, you've got still a very supportive platform for euro dollar amid strong European economic fundamentals in that respect. overlaid by dollar weakness on some uncertainties which seem to be still apparent with the Trump administration at this point. Otherwise, back to the calendar. After IFO, we've got UK net borrowing figures. Very seldom do I say that moves the market, but certainly worth just keeping a half an eye on. And then going into the afternoon, you get the US market manufacturing PMI, service PMI, new home sales, Richmond Fed manufacturing index. You've also got a whole host of speakers throughout the day. Bank of England inflation report hearing. The TSC stands for the Treasury Select Committee. Just for any of the newer guys, what this essentially is that we've already had the release of the quarterly inflation report. This came out earlier this month. What they then do is they present the Bank of England officials the report to the kind of finance department of the government, so to speak, or the TSC. So this is very much a repeat of what we already would have heard. The politicians then grill Mark Carney, try and give him a bit of a hard time about his economic performance of the economy, but net, very rarely is there a market-moving comment that comes out of this event. But still, Carney will be present, so worth keeping maybe half an ear on the mic if they cover any comments. Kashkari, we heard from yesterday, a dove, so expected to remain still of that viewpoint for the time being, but ECB's COA speaking later at 4 PM. Could be something else interesting to watch as well. Okay, so just coming up to German IFO. Going to wrap up then. We got 5 minutes till the data hits. Certainly if this data was strong enough, let's say it's expected to improve again to 113 type area, but if we get a 115 or above type print, this is a multi-year high. We're looking at, if that were the case, well, let me just look back on the chart here for IFO. If we were to print up to 115 or above, that would be all-time highs for that data set. And that would be telling, and that could then contribute to the DAX and the Euro to retest at least, if not break, these earlier yesterday high levels that have been tested already. Consequently, if that were the case, I'd expect fixed income futures to come under a bit more pressure. T-notes, well, the Bunds already closed a gap after the initial reopening gap up that we had electronic trade this morning. T-notes, you've got pivot downside, and gold likewise could see a test to pivot if this number is particularly strong. Okay guys, enjoy your day. I'll see you in the chat room. Again, the figure coming out 4 minutes.